Well, I think there are a few scenarios. One is that it continues to escalate and you go into a full-blown trade war with serious implications for even global GDP ultimately. Another is that one or both sides back down, which seems rather less likely at the moment. The third is that there's some kind of ultimate negotiation agreement, some kind of workable compromise, and that's, of course, what we're all hoping for.
Do you think that's likely? I mean, is that the most likely scenario out of the three that you just laid out?
I don't think it's likely near term. I think what we're likely to see is continued sort of aggressive stance on the part of the U.S. It's been working well for the U.S. so far. And I think China will be very cautious and find its way in this negotiation. I think that's a longer term or medium term possibility, but for the next, at least through the end of the year, I think we're likely to see continued strains.
So then what does that mean for the markets? Because we've seen these trade tensions at least contributing to the global sell-off, especially in emerging markets.
Really, ever since President Trump was elected, he's been talking tough on trade, and markets simply sort of discounted it, right? They said, oh, it's a lot of talk, it's a lot of hot air, not going to happen. Now that it's happening, I think you're seeing quite a reaction because it's coming at a time where global liquidity is starting to wane. We've had years of central bank liquidity provision. The Fed is starting to drain liquidity. Ultimately, that's a difficult backdrop for markets. And then you add trade tensions, a lot of tension.
Well, then as the Fed continues to raise interest rates, can the emerging markets handle this sort of pressure?
I think what we've seen over the past couple of months is increasing pressure on emerging markets because the trade tensions in some sense are something of a last straw. If it had only been the Fed rate hikes, that was well telegraphed, emerging market fundamentals are in pretty good shape. It could have weathered the storm of Fed hikes. But when you add in the uncertainties around how this trade tension is going to play out, it creates a really difficult environment looking ahead into 2019 and beyond for emerging markets.
Well, then where is all the money going to be flowing?
When you look at what fund flows have been doing in recent weeks, what you see is a very clear trend of funds moving to the U.S., both on the equity side, to take advantage of the tax cuts and stronger relative U.S. growth, and the bond side because of safe haven flows.
Why do you think that is?
I think when you have uncertainty, you look for the safest possible bet. So that's an obvious call for U.S. Treasuries, right? Deep liquid market there. When you think about equities, you're looking for the best growth opportunities, obviously. Well, who is pumping fiscal stimulus into the economy now? That's the U.S. And so even if it doesn't last, you got a good deal going on now.
Well, just last question. I mean, you're talking about U.S. policy. I'm curious about your thoughts on Chinese policy because just recently we had the central bank easing on the RRR. So do you think this is a reversal in policy or is it just a one-off?
It seems more of a tweaking of policy, right? And I think this is something that Chinese policymakers do very well at. Since the turbulence of 2015, 2016, there's a lot of confidence built up in especially the PBOC's ability to handle these strains. And I think they've got a great toolbox, and they're going to continue to tweak policy to suit market conditions.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.